Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, September 18, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so last night, while we talked about both sides of the tape, both sides of the market, we laid out some numbers if the market were to continue on the downside, and we said if the market gets above and closes above the high from Friday, that was going to be a bullish sign. As you can see today, we made an attempt to do that. We closed below that level. However, we did make an attempt. In fact, we did go higher intraday than the highs from Friday. This has to be considered bullish behavior. While the market hasn't closed above that high yet, and we're looking for 291.27. So if we look at the high from Friday, this is the 14th, 291.27, any close above that level, and not only do we go right to the former highs, but likely we exceed the former highs. We're too close for that not to take place. At the end of the day, all this really was an up move, a pullback, and then another move higher. We've been talking about this. I have been looking for either one of two things. A lower high, which we still may have. That's not off the table. It's not confirmed that the lower high is off the table yet. We're either looking for a lower high, or we were looking for most likely a higher high, but not necessarily that much higher. How much higher would we be looking for if the market continued higher? Maybe about 20 points from where we are now. 20 S&P handles, $2 in the Spider, something in that vicinity. We'll worry about that when and if we get there. Right now, we're still below Friday's high, and as long as we remain below Friday's high, first on an hourly chart closing basis, but then on a daily chart closing basis, as long as we remain below Friday's high, this market still has the potential to put in a lower high. Before we go any farther, let me pause here and thank everybody for once again participating and making posts and comments underneath the video. They're very helpful to the entire community. Please keep up the great work. I love the interaction. I love the fact that we have people that come here to listen, to learn, and to participate. It's helpful to everybody. In addition, hit the like button on the video and also share the video with those people you think can benefit from this information. All right, so back to the Spider. We know where we stand. This is essentially a bullish chart. We're above all the moving averages. There's nothing bearish about this chart. We had a down day yesterday. That's it. Nothing more, nothing less. Here's our lines in the sand. Our bookends are as follows. On the upside, any close above Friday's high, and that's bullish. And we'll likely see higher prices. In fact, we'll likely see higher highs. Any close below yesterday's low, and that'll be bearish and likely promote lower prices. That'll also entail or encompass getting below the 20-period moving average. That wouldn't necessarily be a good sign. So those are your bookends. Below yesterday's low, above Friday's high. In between, there's nothing doing. Above is bullish, below is bearish. Let's keep it simple. There's no reason to read anything farther into it than that. Hourly chart of the Spider, just a refresher. Remember, we talked about that gap fill yesterday. Here's that gap down here, and it was slightly lower on the 10-minute chart. We filled the gap, so essentially what we did was we went up, we came back in, filled the gap, tested a former breakout area, and we had a resuming trend following or a resuming move in the upward direction, and that's where we stand as we speak right here, right now. The IWM. So yesterday we did complete what I considered from a symmetrical standpoint, that bearish pattern. We actually completed it in earnest over here on the 12th. You can see that the lows were approximately in the same place. And then we actually completed it and finished again down in that neck of the woods yesterday. Today we had somewhat of a retracement. Now the IWM isn't in a bullish position. It's not in the same type of position that the SPY or the S&P 500 is in. It's interesting. We do have a divergence going on here. Today, the IWM was up about the same amount as the SPY. So we're not going to make anything out of relative strength or relative weakness. It didn't exist today, and that's fine. However, you can see where the look of the chart doesn't look the same as the spider. I think that's important information. It's a puzzle piece. It goes on the table with all the other information. We really have a couple of lines in the sand in the IWM. Of late, we're going to use yesterday's high as a line in the sand. So any daily close above 171.54, that'll be bullish for the IWM. If we get a close above that, my indication, or my instincts, I should say, would tell me we would close above the next breakdown candle high. But we'll take it one step at a time. That's our bogey, the high of yesterday's breakdown candle. Any close above that, bullish. Any close below yesterday's low, bearish. Lower prices would be coming under that scenario. The VIX. Well, we were down today in the VIX, and you can see maybe this was a shot across the bow. What's interesting is, remember, we closed. Let me back up the truck here just for a second. So we have a couple of different areas. We have this area here. That's a breakup candle low. We closed below that the other day. That's generally a shot across the bow. That price will continue lower, and that bullish pattern technically was off the table. The next day, which was yesterday, we closed back above that. We call that a recapture. Today we sold off. We'll have to see whether that shot across the bow was meaningful or not, because keep in mind, we have another breakup candle low that emanates from down here. And when you look at this, we never did close below that low. So it's a little suspect. I'm going to leave the VIX alone right now. I'm going to reserve any opinion or forecast in the VIX for another day or two of activity. Let's let this just banter about and play itself out for another couple of days. The transports. So look what happened today. The transports went down to touch home base. We bounced off home base, and we still are inside of the latest breakup candle high, which is also known as a bullish pattern. So we tested home base, or the 20-period moving average. We had a nice bounce off that particular level, and here we are. You can't look at that as bearish. The only way today, based on what's on the chart today, the only way to look at that is bullish. The Qs, technology today was a little bit better. Technology had a pretty decent showing. As you can see, the Qs were up about 0.8%. We're in between the 20 and the 50-period moving average. Are we going to make a federal case out of that? No. What did we test today on the high? We tested yesterday's breakdown candle high, was rejected, and here we are. So we had a retracement at the end of the day of yesterday, but we also retraced the entire day yesterday. However, we weren't able to close above yesterday's high. That's what would be needed to maintain or continue the bullish case. A close below yesterday's low, and the bearish case is back on the table. That would bring lower prices. So it's the same story in the Qs as it is in the SPY. Again, you have bogeys on the upside, and you have a bogey on the downside. We'll take it one day at a time. Yesterday's high, yesterday's low in the Qs. You can use hourly even from that perspective. Any close hourly above yesterday's high, that'll begin to put together the bullish case. Closing hourly below yesterday's low, that'll begin to formulate the bearish case. Remember, the hour is on the half hour. The XBD, the broker-dealer index. So the XBD had somewhat of a dead cat bounce today. Pretty bad day yesterday, up 0.8% today. Not a big deal. This is still a negative-looking chart. It's still a bearish-looking chart. Look where we are in the chart. We're below all the moving averages. You know, today was an up day, but this is in a downtrend. So there's nothing here that tells me you have to buy the XBD. When you look at the XLF is in a little bit better of a position than the XBD. We're above all the moving averages except for the 20-period moving average or home base. So we tested the 200 and the 50 moving average today. Once again, we rocketed off that level. Rocket's a strong word for the XLF. It doesn't move all that much. Finished up 0.4%. The bogey is quite simple. We have to get above the 20-period moving average and this breakdown candle high. 28.39. Any daily close above 28.39, that's bullish. We're going to use this low as the bogey on the downside, 27.97. Any close below 27.97, and you come right down to fill the gap, spiking through the 100 period moving average. That's the only way in my book to look at the XLF right here, right now. I think it's worth it at this point in time to reiterate my feelings about the financial sector. Without the financial sector, it's unlikely we see a whole nother leg higher in the market. You're going to need participation from the financials in order to see another leg higher in this bull market of substance. At the same respect, on the flip side, if the financials begin to melt away, you're likely to see the market follow. However, it's unlikely to see any kind of significant downside in the market or across the markets without downside participation in the XLF and the XBD for that matter. Now, the XBD has shown some weakness, but the XLF has not really. The XLF, from a daily chart perspective, is okay. We understand the weekly chart. We understand the ramifications of the weekly chart, but there still can be higher prices coming. Look, on the weekly chart, we're above all the moving averages. Here's the weekly of the XLF. Here's the weekly of the XBD. The XBD looks much weaker below the 50 and the 20, and you can see, one wrong move, one slip, and the XBD is going to crack through the ice, and it's going to come all the way down at least to about 258, 259 in a pretty big hurry, even as far down as 248 to 245 down here where the 100 period moving average is. So one wrong move and the XBD has a lot of white space in the downside, but it does look different than the XLF. I find that interesting. The XLF still has to contend with this breakdown candle high that comes in at 29.10, but still between 28 and a quarter and 29.10, there's a lot of runway going on there. You can have a nice series of up days in the market as if, and this is if, as the XLF is moving its way up to test the high of the breakdown candle above 29. Think about that for a minute. That is a possibility. We can still have some more upside in this market. Remember, markets like to climb the wall of worry. We always hear there's all these things out there. There's North Korea, Iran, there's stuff going on in Europe in the banking sector, the economy this, the economy that. There's all kinds of stuff out there, geopolitics, that can derail the market. How about tariffs? How many times, think about this for a second, how many times over the last couple of months have we heard that tariffs are derailing the market? Each and every time the market goes down, it's because of tariffs imposed in other parts of the world, whether it be Canada or China or Europe or elsewhere. We had the same event yesterday, and this is really one of the reasons why I don't discuss the tariffs, or I don't discuss a lot of what's in the news cycle during the day when I give my analysis, because how many times have we seen the market down, it's blamed by the media on the tariff news, and then all of a sudden the following day, what tariffs? The market's up, nobody cares. When that happens over and over and over again, you have to believe that it's not really the tariff that caused the market to be down yesterday. It's just a garden variety down day. There doesn't have to be a distinct reason like tariff talk tied to a down day in the market. That's the misconception that most people have. I understand it's a difficult reason, or pardon me, it's a difficult concept to wrap our heads around, the fact that each and every day the market's up or down, we think there has to be a direct reason that the media assigns to the reason, to the movement in the market. But think about this for a second. Let's say, and this has happened, I've seen it happen, I've witnessed it happen. If you look hard enough, you'll see it happen within the next couple of days. So if the market is doing something, up or down doesn't matter. Let's just say the market's going down and you turn on CNBC and they tell you that the reason the market's going down is because, and they make up some reason, whatever that reason may be. We'll call it reason ABC. Now, the S&P's down 20 points at the time. Just for kicks, you flip over to a different station, you turn on Bloomberg, or you turn on Fox Business, or you go to the blogs and you look at Yahoo Finance, you look at Google Finance, You look at any number of thousands of blogs out there in the financial sector, and you start looking for reasons the market is down. And all of a sudden, you find a different reason on Fox Business or Bloomberg or some of the blogs than you found on CNBC. The question is, who's right? And we're not going to dig any deeper into that tonight. That's really my point. I'm making my point is that just because somebody says something doesn't make it true. The SOX, the Philadelphia Semiconductor Index, the SMH is the exchange traded fund that we use to track this index. Not much going on here today. We made an attempt to get through the 20-period moving average, didn't quite do that. We're trapped right in between the 20 and the 100, pretty much just over or on top of the 50-period moving average. So is this a pattern of strength or weakness? It's really neither. It's more of a bearish pattern than anything else. But I can certainly make a case that the bearish pattern played out, right? I can say that this bearish pattern played out the other day, and then we can erase that, and I can also continue to make the case to say that that was a one-day anomaly, and I can draw down here, and I can draw a line over like this and say, well, that's a bearish pattern, and it's likely going to play out here to double bottom. What about this? Well, we'll just ignore that if I want to go with that concept. I don't have a real clear picture in the SMH. If we get above the moving averages, that's bullish, and it's bullish to the top of the breakdown candle high. It's just that simple. Where's the top of the breakdown candle high? It's right here. So if we get above the moving averages, the market will want to push, or the SOX will want to push toward the top of that breakdown candle high. Just that simple. Getting below yesterday's low right here, bearish, will want to fill the gap right here and most likely retest the 200-period moving average. That's the way I see the SOX, the Philadelphia Semiconductor Index. Here's your exchange-traded fund that tracks the same routine. Close below yesterday's low, we fill the gap. You really have to get above the high over here, which also includes the moving averages, in order to see the bullish case, which would be a test of the breakdown candle high. That's it. SMH, SOX, that's the story in those vehicles. Looking at the gold market, we had some lines on the gold chart from yesterday. I don't want to confuse the issue. Let me talk about the daily chart, then we'll go back and talk about the lines, and then I'll take them off and we'll come back just to give one last glance at the daily chart. So, daily chart, bullish pattern, right? So this is consolidating. It's going back and forth. As long as we stay inside the low of the breakup candle, that remains bullish. Close below the low of the breakup candle, that's bearish. The low happens to be 1189.50. No change in the story in gold. Let's go down to the hourly and look what happened. So we were in gold. I don't remember where gold was when we were making the video yesterday. I think it was somewhere in this neighborhood here, and I said this is a classic pullback pattern, and hypothetically, and we stressed it was hypothetical, you would be looking for higher prices, and these are the targets that we gave. Well, guess what? It actually pulled back instead, now making another attempt, now pulled back again. So what you can see from that, or what we can infer from that price activity, is 1204, 1205 is your bogey. You've really got to maintain hourly closes above 1205 in order to see higher prices. Seems to be struggling to do that. But even at that, you can see what happens. The market is like a staircase. So we have three essentially breakup candles in a row. Okay, so let me just point them out. And this is interesting. So we have 1, 2, and here's the third one. Okay, so you can see what happens is once we close below one of them, the next one becomes activated. We begin looking toward the low of the next breakdown candle high or breakup candle low. In this case, it's a breakup candle low. And what's interesting is you can see here the last one in line, we never closed below that. That's interesting. So we spiked it, but we never closed below it and started back up. We tested it a number of times. So you can see the importance of that particular price level. So this is the way that what we do when we analyze markets is we try and find on the chart what seems to be, at least for that point in time, an important price level on the chart. I can pick out a couple of interesting and important price levels. Just looking at this 60-minute chart, I can say that the low of this breakup candle is important. We never close below it, and you can see the market continues to test it and struggle. We can't close below it. That's bullish behavior. Likely story is it wants to go higher. There's another important price level, and that seems to be around 1204, 1205. You can see what happened. We get above it, we come down to test it from above it, and then we break down and we can't get above it. We do get above it, and we come back to test it again, and we get below it, and we have trouble once again. So you can see a couple of distinct, important price levels on the gold chart. Now, again, it has nothing to do with the fact that this is gold. I'm just looking at a chart, happens to be a 60-minute chart, happens to be of gold, and I'm just letting you in my mind. I'm just telling you what I see on the chart. So I'm going to get rid of these lines. We really don't need this stuff anymore. We're just going to go, and I said we would go back and look at the daily chart. We're going to go with the daily chart, and what we have here is, and we like to keep things simple, it's the KISS theory. Keep it simple, stupid. We're going to say that this is a bullish pattern until and unless we close below the low of that breakup candle. That was a crooked line just for kicks. I have to do that again. So here's a straighter line. Not easy to draw the line straight freehand. However, any close below that breakup candle low and that bullish pattern is off the table. Until and unless that happens, we should have higher prices. And the longer this goes on, the less important the 50-period moving average will be. In fact, the longer this goes on, the gold market is likely to trade up and through the 50-period moving average. Keep that one in the back of your mind. Now, here's the gold market. Now, gold had an update today. We're still above the moving averages. We still can make a run for 72, 75 in that neighborhood in crude oil, but we really have to get going. I mean, we can consolidate above the moving averages. That's fine. What we're going to use as the bogey is this low right here, the low from the 14th. Any close below that low, we're going to use the low from the 13th. Any close below the low from the 13th, and likely story is the upside is at least off the table on a temporary basis. If we close below that low and stay above the moving averages, we'll give it more time. Closing below that low will likely cause crude oil to close below the moving averages. That's why I said that. So there's the story in crude. I don't have a long position. I don't have a short position in crude nor gold, so I don't have a dog in the fight. I'm just calling balls and strikes, telling you what I see. This is short-term bullish, but only up to this 72 and a quarter area. 72.75 was even too high. 72 to 72 and a quarter. That's where the upside is. You close a day above the high of this breakdown candle, 72.53, and that'll bring higher prices. And we'll leave the daily chart of crude at that. And with that, folks, I'm at a win tonight, so I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.